Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to talk about one thing and one thing only. It's the thought on everyone's mind. It's the big hot news of the week. It's what the market has been selling off for. It is inflation. If we go ahead and go to the research tab here and we search QQQ, which is the Invesco QQQ Trust or the NASDAQ, and we look at the 1 month chart, you can see that they're starting to have some really heavy red days in here. Some days with the index down 2 or even 3% just in this last month. And for the first time ever, we're starting to see some weakness in the market for 2021. The market has been white hot. It's been going crazy. And for the first time ever, we're starting to see a little bit of a pullback, especially for these high growth companies, specifically in the tech sector. But I think the reason that we're seeing this is mostly because of this one piece of news. Inflation speeding up in April as consumer prices leap 4.2%, the fastest since 2008. 13 years was the last time we saw inflation hitting these levels going back to the early 2000s. So that is a big difference in our economy. And I'm going to talk in this video about inflation. This whole video is going to be dedicated towards it. I'm going to talk about how you should look at this as an investor, how this will affect savers, people who keep money in a savings account, how this will affect people that need to take on debt, whether that's a mortgage or a car loan or whatever. And more importantly of all that, we're going to talk about how I'm going to be treating this in my portfolio. What will I be doing with my investments and how will I be changing my strategy around inflation? Because those of you that follow me know that I disclose everything. I show my buys, I show my sells, I show my dividends, I show gains, I show losses. I disclose each and everything on the channel that you could possibly imagine, and I'll also be showing the strategies that I'll be implementing to combat this fight for inflation. And I'll talk to you guys about why my portfolio I think will be set up better for the long term than many other people's portfolios when it comes to inflation, and I'll go over exactly why. But before we go over all these articles, because there's a lot to go over, and like you can probably tell, there's there's a lot of articles that we're going to go over. But before we get into all that, these are the 22 companies that I own. If you haven't seen me before, my name is Jordan. I'm the Millennial Investor, and I track my annual and monthly dividend income through these two charts right here, and I update them every single month. I also update my portfolio value and my monthly YouTube income, as well as publicly post my investing goals for 2021 and my 2021 stock market prediction. And as you can see from one of these goals, one of them is to hit 150 referrals to M1 Finance, and the good news is we're on track to hit that goal. If I scroll up here and I click Refer and Earn, we have 110 people signed up. And that is because if you go down below in the description and you sign up using that link, you will get $30. Usually it's 10. They're tripling down the bonus right now, so you'll get $30 just for going down below, signing up with that referral link, and depositing $100 to the platform. And if you want help getting started as an investor with me, if we want to talk about inflation or anything else that you need involving finance, I have mentoring calls that are listed down below in the description. My email is down there, so if you want to contact me with any questions, concerns, anything like that, feel free to reach out. But also there's other things as well, including auto savings accounts, credit card referrals, and lots of other things like that. So I hope you guys enjoy this video, and let's go ahead and get started. So the headline news: inflation speeds up in April as consumer prices leap 4.2%. The fastest since 2008. Now, a lot of people, as the stimulus has hit, as quantitative easing has been at sky high levels, inflation is finally starting to pick up because these things take time. If stimulus checks are issued today, it usually takes 2, 3, 4, 5, 6 months for that to really start to funnel into the economy because some people don't spend them immediately, some people save them, and also from other factors like quantitative easing. That's more of an indirect way to maybe, the key word there is maybe, because of the way that they keep reserves at the bank. It's a really complicated issue. But as you can tell, this number of 4.2% is much higher than anything we've seen basically in my lifetime. I was born in 1999, and this is basically one of the top numbers, one of the highest numbers we've seen since the 2000s, basically since I've been alive. Most of my life, this inflation number has usually stayed between 1 and 3%, and 4% is a very high uproar considering where we were just 1 year ago. So we go further and we look at something like this. Another inflation gauge comes in hot with producer prices jumping 6.2% in April from a year ago. The producer price index spiked 6.2% for the 12 months ended in April, the largest increase since the Bureau of Labor Statistics started tracking the data in 2010. So that's why you see this, because this does not go back back to 2008. This only goes back to 2010 when they started this. But 6.2% is a big increase, okay? We keep on going further and we see another key article like this. Record surge in used car prices is key culprit in inflation jump. And this is really interesting because you see things like chip shortages globally, right? Vehicles are one example of something that is really surging dramatically. The cost of previously owned sedans, pickups, and sport utility vehicles soared 10% in April. Not a little dramatic 2, 3, 4%. We're looking at double-digit increases. 10% in the month of April, according to the Bureau of Labor Statistics, the government agency that tracks this, right? The fastest climb ever in that data goes back to 1953, almost 70 years ago. 68 years ago was the last time we saw an increase in vehicles at that level. That's dramatic. Now, like I said, there's some unique things that's happening with the chip shortages, but that is incredible, okay? A 10% increase is dramatic. And for the first time ever, when you see these headline news of inflation, usually it's just data, government data that people don't really pay attention to, right? But do you remember going back last year to the time of COVID? Do you remember the negative article after negative article after negative article that you would see every single time you saw CNBC, Market Watch, Bloomberg, The Motley Fool, whatever? Any investor relations page that you could possibly find was giving negative articles left and right, okay? And you would see things like analyst projects that unemployment's going to 40% or GDP is going to negative 50% or whatever negative thing they might be posting. You're starting to see that now. These are two Market Watch articles that I pulled up here, okay? It says, what does inflation mean for the stock market? It's supposed to be a positive, but investors are spooked now. It's a little on your edge, right? Like, should I be spooked? Should I be like these other investors? And then even better than that, we have the second one that I found. The biggest inflation scare, in quotation marks there, inflation scare. The biggest inflation scare in 40 years is coming. What stock market investors need to know, that call to action, what you need to know from this 40-year largest investor inflation scare ever, right? You see these big headline articles, these big buzzwords, inflation scares. What does it all mean? How does this affect investors? And it's interesting to see the story that plays out because a lot of these news articles love to play this. This is how they get clicks. This is how they make their money, right? Inflation scares coming, top in 40 years. And it's interesting to see investors fleeing out of the stock market because of these articles. Now, I wanted to talk about the federal funds rate before we jump into all this and we talk about some of my companies and how this relates to people going forward. Before I talk about investment specifically in my stocks, I want to talk about the federal funds rate. Because basically what the federal funds rate is the simple way of saying the risk-free rate of return, okay? This is what investors can earn for virtually no risk. Because with the federal funds rate, this is where they sell things like short-term treasury bills, things that are due 30 days from now. And they usually pay really low interest, but they are virtually no risk. There's no inflation risk because they're only 30 days long. There's really no risk of repayment because the government could always just create as much money as it needs to. And basically, this is the way that people gauge whether or not they should invest in the stock market, especially your big banks, your big hedge funds. A lot of your wealthiest investors will not risk money in the stock market if they can get a free 5% on the federal funds rate and instead risk it for a potential 8% in the stock market or 10% in the stock market, okay? And so this chart shows the federal funds rate going back to 1998. Once again, I'm a 99s kid, so you can see that pretty much ever since I've been born, other than the exception of 2006, 2008, the federal funds rate has pretty much been at 3% or lower my entire life, especially my adult life. It's pretty much been at 0 or close to it this whole time. And for the first time in 2015, 2016, we started to see a little bit of a bump up going up to 2%, 3%. And then thanks to the coronavirus, took everything right back down to 0. So as this number starts to go up, because inflation goes up, interest rates will start to go up, i.e. the federal funds rate. What will this mean? Well, first of all, for the saver, if you're somebody out there who likes to keep money in the savings account, if you like risk-free money, if you like to keep money in a savings account, or if you like to put money into a CD or things like that, right? If your savings account now pays 1% and this starts to raise, your savings account will no longer pay 1%. It might start offering 1.5, 2%, 3%, 4%. It will start going up. And the CDs, the same thing as well, like a certificate of deposit or something similar to that, right? If it pays 2% right now, it'll start paying 3, 4, 5, 6% as interest rates go up because the risk-free rate of return is higher. If your risk-free rate of return is 5%, then people can start offering CDs for 6% to loan it out from banks, right? And so savers, it sounds perfect, right? Yay, hey, we're getting more free money. There's no risk here. But here's why this is not good as a saver, and here's why you should be investing in the stock market regardless. Inflation is almost always going to run higher than the interest rate for the risk-free rate of return. If the risk-free rate of return is 2%, then that likely means that inflation is running at 3, 4, 5, 6%. So you're still losing buying power. Inflation is just the price of costs and goods going up over time. And so if that's running at 5% inflation year over year, and your savings account is paying, say, 3%, that's a 2% spread, a 2% difference that you're losing on your money every year. You're not risking it. It is free returns, but are you really making money? Not really. So that's why the risk-free rate of return is not that appealing for any investor. It's good to have cash on the side, but still putting your money in a savings account is not the way to create wealth long term. We keep on going further than that. If you're a lender, if you're someone that's wanting to loan out money, if you're wanting to take on a loan, if you're wanting to take on a mortgage, if you're wanting to get a used car like we just talked about going up 10%, if you're wanting to get a loan, that is now going to slowly and slowly start costing you more and more. That car loan that you got an offer for 7% interest, next year it might be 9%. The year after that it might be 12%, 14%, whatever the case may be. That's dramatically going to go up over time because the cost that it will cost those banks to loan you that money will increase the interest that you'll have to owe them over time, right? And so for people that take on debt, for people that take on loans, this is really, really going to hurt them. That's really who's going to be the loser to this. The people that don't have any money in savings and the people that take on a lot of debt. Your car loans, your consumer debt, your credit cards, your mortgages. These are the type of things that are really going to get hurt. And a big one is people with student loans. There's a lot of people my age that have $40,000, $60,000, $100,000 in student loan debt. And if this were to start going up in a dramatic way with the federal funds rate paying out 2, 3, 4, 5%, that's when student loans would get crazy. Okay. And then so we'll talk about investments. How does this affect your investments? Because people have been selling out of stocks, specifically in certain areas. A lot of high growth tech names, companies that are not profitable, companies that have unproven business models, not as much of a defensive name, more of a high growth speculative company, is selling off significantly harder than a lot of defensive companies like I typically own in my portfolio. And so we see articles like this. Procter & Gamble will raise prices in September to fight higher commodity costs. And then you see other companies tagged in this article as well, including Coca-Cola, Kimberly-Clark, Procter & Gamble obviously, but there's other ones like Pepsi and a lot of other big names like Caterpillar. All these companies that I use, they've been announcing price increases. And I want to talk about, as an investor, why now more than ever, as inflation is potentially looking at going up, now more than ever, cash flows on a business are vitally important. Because I want to give an example, okay? I want to talk about a company that has had to raise capital over and over and over again. I want to give an example of Canopy Growth Corporation. This is not a knock at them. I'm just using them as a highlight, as an example, okay? This is a company that loses a lot of money. They dilute shareholder value big time. And the only way that this company can get money, because they lose so much of it, is that they have one of two options. They can either take on debt, they can take on a bunch of loans from banks, or they can dilute shareholder value by issuing more shares to the public. That means that your investment will now be worth less because there's more shares available. If you have 10 slices to a pie and there's 20 people fighting for it, then half of the people in the room get a piece. But if there's 100 slices to a pie and 20 people are in the room, then it's not much of a fight, and so that value of a slice of pie is not a big deal. The same thing goes for shares in a company. If there's 1 million shares available and now there's 2 million shares available, there's not a big as demand, and typically the share price will dilute over time and lose value. And the same thing for loans. If these companies are taking on loans to raise capital, okay, and it's not just Canopy Growth Corporation, it's really any company that's not putting up any significant type of profit, if they're losing money, if they're not really making significant profits, or especially if they're money losers, the option of taking out loans, taking out debt for the banks, are going to get much more costly. And a lot of them will not be able to afford it or even be approved for the loans in the first place. Many of them will be forced to do what a Canopy Growth Corporation would do, and that's dilute shareholder value. But luckily, we look at my portfolio and we notice that every single one of these companies are extremely profitable. Not only are they profitable, but they are extremely profitable. And that's why nearly every single one of these positions, with the exception of Kimberly-Clark with that bad news report that they just had come out, and we're only down, what, 1% on the company? Ooh, big whoop. Actually, that's a money weighted return. That's not even a time weighted return. So we're down like, what is that, like 0.6%. Such a fraction of what I even invested in, a couple dollars. But if you look at all these companies, they all have one thing in common. They produce significant amount of cash flows. And this is why a defensive portfolio like mine, like a dividend growth strategy, is better than pretty much any strategy out there in my opinion. It's not financial advice. I can't recommend anything to you guys, but this is why I love it. Okay, let's look at Lockheed Martin, for example. This is one that I just increased my investment in, and I want to show you how this company does not care what happens with inflation. Oh, and by the way, I should probably mention, in the same way that we just saw a bunch of headline articles like Procter & Gamble, Coca-Cola, Kimberly-Clark, Pepsi, Caterpillar, every single one of those companies that I just named have all continued to raise dividends going back to the worst time in inflation history. Go back and look at a chart and look back to the 1970s, specifically the 1980s, when inflation was well into the double digits. 14, 16, 18% inflation year over year. That's over 1% price increases a month. All these companies not only stayed in business, they continued to raise dividends. They continued to put up cash flows. Because in a time of inflation, when everything is sky high with interest rates, cash flows become more important than ever. And I think that either one of the two things is going to happen. I think that if inflation really starts to cement into the economy and these companies really start to come down in value, and I think that it's a buying opportunity because these discounted cash flows are going to give you better returns on your investment. These like for example, let's look at Lockheed Martin. Lockheed Martin offers a 2.5% dividend yield. If this company goes down in price to say $300, then the dividend yield will shoot up to 3% plus. You're now getting more return, more cash flows, and the same way that that risk-free rate of return goes up, your dividend yield will go up as well. You're now owning more of the company for less than you had to pay for it 6 months ago, 12 months ago. And for a company like Lockheed Martin, for example, they have contracts with the government that are 3 years, 5 years, sometimes 10 years out into the future. They have a backlog of billions and billions of dollars for the Air Force that, like I said, that go years and years and years out into the future. This company only pays out a third of its profit in the form of dividends. That's because they're so profitable that they can afford a 2.5% dividend yield and still invest roughly about 2/3 of their profit back into the business. Reinvest back into research and development, into new products, new innovative technologies. Their CEO is an incredible CEO. The government backs them 110%. And it's not just Lockheed Martin. We can just pick another one from the list. How about, since we looked at Kimberly-Clark, how about we go ahead and use them as an example since they were featured in this article? Kimberly-Clark is the only company that I'm down on in the 22 companies in the dividend growth portfolio, okay? In the last 5 years, this company hasn't won a whole lot, and especially this year in 2021, it's starting to have a little bit of a downturn in prices. And that's why I've increased my position in this company. Because guess what? The reason that this company is successful has nothing to do with the quality of their products. What does this company make? Diapers, paper towels, napkins, toilet paper. These are not innovative, crazy products to make. Anybody, including me, including you, if you wanted to try to create your own toilet paper, you could probably make it happen. I mean, what really goes into making it? Not a lot, right? A little bit of materials and some packaging, not a big deal. Toilet paper is not a hard thing to make. But why does this company continue to raise dividends year in, year out? Why does this company's share price continue to grow over the long run every single decade, year after year after year? That is not because of the products that it sells. That is because of the powerful brands that it has. The companies in my portfolio do not always have the best products. Many of them do, but they don't always have to have. They have to have incredible branding power. Brands are sometimes, a lot of times, frankly, the most powerful assets in the world. Okay? A lot of people, for example, if you're wanting to build something, if you're wanting to construct something, you'll go with a trusted name like a Caterpillar. They're huge, they're dominant in their field, and they're a trusted brand and have awesome products for pretty much whatever you need as far as construction goes. What about McDonald's? People grow up from the time they're babies. Who does McDonald's market out to? They market to children because children fall in love with them through their little toys that they offer in the bags, right? Their little McDonald's kids meals. And then they fall in love with them, and they're not customers for the time that they're children. No, they grow up loving McDonald's, and then they eat at that company for decades and decades on out. They grow up in their 30s, their 40s, and then they take their children to McDonald's, and the cycle repeats itself over and over and over again. The same thing for Coca-Cola. Anybody can make a soft drink, including Pepsi. Anybody can make a soft drink to compete with either one of these two, but nobody has the branded power and the trusted name behind Coca-Cola and Pepsi like these guys do. I could go down the list over and over and over. And the good part is, while inflation may put a little bit of fear in the market, while it might get you a little bit scared about your purchasing power or your investments in general, here's to know if you should be worried or should not be worried. Look at your portfolio and ask yourself the question, are my companies profitable? Are my companies defensive enough to handle any environment? If inflation goes down, will they be okay? If inflation goes up, will they be okay? If the stock market gets really scared, if valuations come down, if PE ratios come down, if people move money to bonds, if the government has worries about funding issues, if there's a war that breaks out, if there's a 2020 virus that breaks out, will my portfolio be okay? If you didn't answer the correct answers to all those questions, then you're probably not investing right. And that's why I showcased in my last video a company, for example, something like a space stock, Virgin Galactic. If you look at the year chart on this company, it's pretty pathetic. It's pretty sad. A company that was trading at $60 plus is now trading at 16. This is a company that, for example, like I was talking about, does not make profits. It cannot raise capital without diluting shareholder value through the form of debt or issuing more shares. My companies don't have to do that. They're so profitable that they can still reinvest back into themselves, and they don't have to issue debt if they don't want to. In 90% of occasions, they'll be just fine no matter what happens. And so if you're investing in companies that are going to have to dilute your value, that you're going to have to be scared of what will happen with inflation or really any economic fear in general, then you should probably reevaluate your investing strategy and go with a more defensive portfolio and something that fits your investing needs. But I hope you guys enjoyed this video. Like I said, if you enjoyed this video, I hope that you'll subscribe, and I hope you can get signed up with M1 Finance because they're giving a $30 promotion right now, and I really appreciate you guys watching all the way to the end. But thank you guys for watching, and I'll talk to you guys next time.